Hey everyone, happy Friday. Jason Jacoby with Boyer Financial here with Friday's closing bell. Hopefully you're all having a great week. And we've had an interesting week to say the least here in the office and in the markets. So obviously last week was a rough one for us. We had a nice bounce. We call it a relief rally on Monday and Tuesday. Wednesday was pretty flat. Thursday, Friday, back to some decreases in deflationary principles in the market. Today being a little bit more of a negative, almost 2% down in the Dow Jones at the time of recording here, due to some big payroll information and jobs report information that came out this morning. So we'll get into that, but I just want to give you a brief recap on the markets year to date so you can kind of see where we're at. Dow Jones, we're down about 19% year to date. S&P 500 down about 23.5% year to date. NASDAQ down about 32% year to date, and the Russell 2000 down about 24% year to date. So obviously not great numbers. It's been rough with Treasury yields spiking, with the Fed raising interest rates, to inflation reports, to job reports. It's just been a rough year for the market as a whole. If you look at the aggregate bond index, which measures the bond market as a whole, it's down about 13 to 14% year to date, which is obviously not good because I like to call it a seesaw. So usually when the stock market's doing bad, the bond market's usually doing better and is providing the hedge against the equity downside that you're experiencing in a portfolio. So the traditional 60-40 portfolio people like to talk about, it really has gotten hit pretty hard this year, just like everyone else's portfolios. So we'll kind of get into the portfolio side of things in a little bit here, what we're seeing, what we're going to do. But on this Friday closing bell, just want to talk about the big employment situation report that came out. Non-farm payrolls came out. And while we're technically showing a pullback in the labor market, I'll give you the numbers here. 263,000 jobs were filled in the month of September. That's a lot, right? But it's actually below, by a modest amount, 275,000 that was expected. Now, what does that mean? The employment rate has ratcheted down from 3.7 to 3.5%. Again, back to those historical lows that we experienced right before the pandemic hit us. And with that those numbers coming out, it means there's a tight labor market, right? When there's a tight labor market, wage pressures, wage increases becoming more likely. It's a more competitive job market. So that's what we call good news is bad news, right? It's good that the economy is adding jobs. It's good that people are working and wages are increasing. But the downside to that is the tight labor market and wages increasing. People spend money. It only adds to the inflationary pressures that we're currently feeling, which equals what? The Fed raising rates even more aggressively. Could be another 75 basis point rate hike here in November. And then we'll kind of see, as of next Thursday, the consumer price index, the inflation report will come out next Thursday. So next Friday closing bell, get ready for that one. Should be a good one. Should be pretty interesting. We'll see kind of where we're at with inflation. But the fact that we added less jobs than expected, again, that's a cooling job market. That's good, but it's still quite high. And again, it only adds to inflationary pressures. So kind of what does that mean? Where are we going? Recession, no recession? In our opinion, we're already technically in one, obviously with the GDP contracting the last two quarters, quarter one and quarter two. It's also an interesting recessionary time as well. You have Peloton cutting another 500 jobs, just 12% of their remaining workforce. You have other companies as well doing the same. I was actually just reading here. I'll kind of give it to you. Facebook, Snap, Stanley's Black & Decker are cutting jobs as well. Amazon and Google are doing a hiring freeze or pulling back on hiring. So you're starting to see the layoff piece come into play, and those are lagging economic indicators, right? So when the economy is already bad or getting worse, those numbers, those jobs that are being cut kind of follow that, right? People don't get their jobs cut, or companies don't cut their jobs until things are grim. The outlook's already looking grim. So again, in our opinion, we're already in one or tipping into one. just based off of those numbers. It's kind of a weird one as well, again, because of COVID, because of all the stimulus in the economy. It kind of, I think it just adds a little bit of a wonky, a lot of the normal economic indicators we look at aren't flashing recession yet. But again, I think it's just because of all the fake stimulus that was injected into the economy. The Fed waited so long to raise rates, which is why they're raising aggressively, and hopefully not too aggressively. Again, if you read our client letter that came out the other day, we just hope that they don't overly raise rates here where it brings the economy to a standstill, which could spell a deeper recession. Again, something we're watching, but it's quite interesting to think about. So portfolio wise, again, I think patience is going to win the day. Now is not the time to sell. Markets have already been hit pretty hard. I think the majority of the losses have already happened. Again, could we reach new lows? Absolutely. But if you look at an average recession, the S&P 500 technically is down about 24%. So we've hit that already. Could it go down to 30%? Absolutely, it could. But it's, again, short term, we don't know. It's to be seen kind of how long inflation sticks around, jobs report, and hopefully the Fed, again, doesn't overdo their hand here. And then also, what people don't talk about, and I really want to talk about this, again, this is our opinion here. We always talk about tapering off demand. We really need to increase supply. That's also a way where we don't have to taper off demand. We can actually increase supply side deregulation, opening up the Keystone Pipeline again, which would obviously lower gas prices. We could actually be making money as a country as well by actually outsourcing some of the extra oil that we do produce to Europe, to other countries that need it, so they don't have to rely on Russia and the Nord Stream pipeline that is basically being held hostage by Putin. So again, just our opinion, but deregulation, increasing supply side will lower the cost of goods. That'll help. We don't have to rely on the Fed completely to do that. We can utilize some deregulation and hopefully get this thing under control, but that doesn't seem likely right now. So we're going to have to rely on the Fed, unfortunately, to get this inflation under control with the increase in rates. It's going to be tough for a little while, so keep cash on hand. And make sure you got your rainy day funds. 3 months, you've got 2 steady streams of income of total outflows. So 3 months of total outflows in your bank account sitting in cash. So if something were to happen with jobs, you can at least have 3 months of a rainy day fund built up. If you've got 1 stream of income, or a big discrepancy in income, so if you're a high earner and a really low earner, you want 6 months in wet powder, or in dry powder, I guess I should say, sitting on the sideline there for the worst case scenario, and hopefully you don't have to use it. So hold your positions. Now is, again, not the time to sell unless you want a tax harvest, which is kind of what we've been doing in our client portfolios. But other than that, just position for the next year. We love dividend payers, dividend growers. That's kind of our core ethos and philosophy that we really like, is, again, time-tested returns, companies that aren't cutting dividends but are paying consistent dividends and even increasing them over the long term, that have ironclad balance sheets, steady cash flow, and can kind of weather recessionary storms. We really like those sectors. So if you have any questions, reach out. We're always here to help. My name is Jason Jacoby. I'm here with your Friday closing bell. Stay tuned for next Friday Inflation Report.